Netflix just dropped to around $110 after a 10-for-1 stock split. And investors are already asking the only question that matters. Does this make the stock all of a sudden a bargain, or is everyone walking straight into an overpriced trap? And digging through the numbers, I'm still not convinced that retail investors know what they're actually buying. I mean, Netflix is sitting on more than 300 million subscribers. They're operating in over 190 countries, and they're pumping out hit after hit that keeps people locked into the platform. But what no one's talking about, even at this new lower share price, the stock is still trading at the same forward PE of 45, which is still more than 50% of the sector. Many of us are celebrating the split, but I'm watching something completely different. It's a specific signal inside the valuation that tells a very different story of where this stock could go next. And it's the one thing that I think us retail investors consistently overlook. So that's why by the end of this video, you're going to know whether Netflix is actually a deal at $110. You're going to know how that valuation stacks up against the real fundamentals, and what I think long-term investors should be watching before buying at least one more share. Hey, what's up? My name is Rick Orford. I've been trading since 1999, and no, I'm not a financial advisor. That is a good thing. I break down the numbers so retail investors like us can make smarter, more confident decisions with our money. By the way, I wanted to give a quick shout out to our friends at Moomoo for sponsoring this video. I gotta say, I'm loving their AI assistant. I mean, it's kind of like ChatGPT, but it's connected with real-time market data, so you can get in-depth and pinpoint analysis. And if that's not enough, new and qualified users from the States can get up to $1,000 worth of NVIDIA stock and up to 8.1% APY for a limited time with their cash sweep program. Scan this QR code or check the link in the description to see why 27 million users trust Moomoo for their everyday trading needs. With all that out of the way, let's get into it. Now, in case you've lived in a cave or under a rock for the last 30 years, Netflix is a company that's been around since 1997. They actually started as a DVD rental company, believe it or not. And in 2007, they made the switch to streaming, which completely changed everything. And that move didn't just shift their business, it reshaped the entire entertainment industry. Today, they're in over 190 countries, and they're the biggest streaming service in the world with more than 300 million subscribers. And the crazy part? They're still growing, which is why investors are still watching this stock like a hawk. So what exactly does Netflix do to make money? Well, pretty simple. Of course, they provide streaming entertainment that you can watch whenever you want, wherever you want, on any device that's connected to the internet. That can be TV shows, movies, documentaries, and a ton of original content. So, in other words, Netflix is selling attention, and they've gotten very, very good at it. And to be fair, there's a pretty big chance that you've at least once binge-watched one of their shows in the recent past. I mean, shows like Squid Game, Stranger Things, Wednesday, and its other original programming have entered pop culture in ways that no traditional studio has managed to do so in years. And that kind of cultural dominance doesn't just attract viewers, it attracts the long-term capital. And what's even more interesting is how they've evolved over the years. They've gone from just licensing content from other studios to actually becoming a major producer themselves. And this shift matters because owning the content means owning the margins, and margins are what drive valuations. And that brings me to a question I think that everyone is asking right now. Is Netflix still priced for that growth, or is the market getting ahead of themselves today? Well, Netflix right now is trading at around $110 after its 10-to-1 stock split on November 17th. Now, a stock split is when a company increases the number of outstanding shares, and they do this by dividing each existing share into new ones. The result is the stock price decreases proportionately. Think of slicing a pizza, a 12-inch pepperoni pizza that was initially cut into 4 slices. And now it's cut into 8 slices, but they're 8 smaller slices. Same pizza, smaller slice. So Netflix was worth around $471 billion before the stock split, and after, well, it's still worth $471 billion, only with more shares. So there's nothing magical that's happening to the company's value. It's the investor psychology that kicks in. Now let's talk volatility. Netflix has a 60-month beta of 1.58. That means it moves about 1.5 times more than the S&P 500. I mean, it's not really that volatile. And that's important because investors love stocks that move, but not those that whiplash. I'm sure you know one right now that you can think of. Now, Netflix stock is down over the last 6 months, but is still up 24% year to date and up 34% over the last year. So even though the share price looks lower post-split, the trend tells a very different story. And that's where the retail investors often get mixed up. So Netflix just went from trading around $1,100 to $110, which means the shares are now suddenly more affordable. But remember, stock splits don't affect the company's actual value. So in this instance, affordable is not the same as cheap. So how do we tell if Netflix is actually cheap right now, or if it's quietly expensive? Well, to answer that, we need to look at the valuation, which is something that comes all the time on my Discord channel. And honestly, I think it's one of the most misunderstood parts of investing, which is why people get burned. For those who are new to the term, valuation in finance only refers to the process of determining the current value of an asset. For stocks, companies are often valued based on their earnings, revenue, potential growth, market position, or even a combination of these. Valuation tells you what you're paying for and whether it's worth it. And one of the most common valuations for profitable companies is the price to earnings ratio, or the PE. PE is calculated by dividing the company's current stock price by its earnings per share. Generally speaking, the lower the PE, the better. And this shows you how much investors are paying for the stock. Think of it like a multiple on the company's profits. It's kind of like a shortcut for how optimistic or pessimistic the market is. For example, Netflix has a forward PE ratio of 45. That means that at $110, investors are paying $45 for every $1 of the company's estimated earnings for the next 12 months. So there you go. Now you have a PE. But remember, a company is worth more than what it earns. It has assets, after all. Plus, without scale or a reference range, that 45 PE tells us less than what we'd like to know. I mean, it's like knowing the price of a car without knowing the model, the year, the mileage, or the condition. Technically correct, but practically useless. So how do you tell if it's actually cheap or expensive? Well, the next step would be to compare it to the sector's overall price to earnings ratio. And Netflix is operating in the consumer discretionary sector. So a quick Google search would tell you that the PE ratio of the consumer discretionary sector is between 28 and 30. That means that Netflix is about 50% more expensive than the current sector's PE. It also means that investors are pricing in future financial performance that has not yet materialized. And whenever a stock is priced far above its peers, it's basically the market saying, this company better crush expectations every single quarter. Because if it doesn't, the results, they're going to be catastrophic. And this is exactly what happened during the dot-com bubble. Back then, stocks were trading at multiples of hundreds of PE ratios, even if they even had one, because many, they were operating at a loss. And if you operate at a loss, you don't even have a PE ratio because there's no earnings. Anyway, when that bubble burst, stock prices, they went on a nosedive. They went off a cliff. And history doesn't necessarily repeat itself, but it definitely rhymes, especially when valuations run hot. And if you need a more recent example, just look at Palantir. What happened just a few weeks ago? Back in late October, the stock was trading around $184 with a PE of almost 800. It even closed at $207 on November 3rd, right before they announced their earnings. Then, once they released their third quarter financials after market hours, they proved they had massive growth across the board. The company even said, quite accurately, that they crushed expectations. That's good news, no matter how you spin it. So you'd have expected Palantir stock to go up, right? Well, no, they actually tumbled, ending to around 171 where it is today. And this is a classic example of stretched valuations, because when expectations get stretched too far, even amazing news can trigger a sell-off, and that's the danger zone that us retail investors often miss. By the way, I do tons of videos about this, about things like this and popular stocks every single day. So be sure to keep an eye on the channel for more. And trust me, the next few months in the market, I think, are going to be anything but quiet. So is Netflix stock a buy at these levels? Well, consider that a consensus among 47 analysts rate Netflix stock a moderate buy with an average score of 4.3, and they've set a high target price of $160. High target prices are the highest price that analysts think the stock will reach in the next 12 months, and that suggests as much as 45% upside based on the price. And when analysts project upside that large or that high, it almost always means investors are expecting a big year ahead. But at 45 times earnings, it's not exactly cheap, so it might be worth waiting for a better price point if you want to jump in. And that's why timing and positioning matters, even with great companies. If I was a new investor looking to buy Netflix, I'd probably be dollar cost averaging my way in. Maybe buy it in chunks over the next few months over time, and then reassess once Netflix releases its fourth quarter financials in January. And that earnings release might finally answer the big question that keeps coming back. Is Netflix still growing fast enough to justify its premium today? But what about you? Are you thinking about buying Netflix after the split? Do you own it? Are you holding it? Let me know in the comments below. And while you're there, if you found the video helpful, do like and subscribe, because it'll help others find the video, it'll support the channel, and you won't miss out on any of my future deep dives. Well, folks, that's it for me today. I want to thank you so much for watching, and I'll see you next time.